So number one, the first psychological trait is this, is to be extremely disciplined. If you want to succeed in investing, you have got to be extremely disciplined. Now, what does discipline mean? Discipline means that you only buy and sell based on predetermined objective investing rules. For example, when this happen, you buy. When this happen, you sell. All right. So for example, in the value investing course, I teach people that before you buy the stock of a business, what are the rules? For example, number one, the company must have a sustainable competitive advantage. It must be undervalued. It must have consistent growth in sales and profits. There are certain rules, right? At the same time, if the company meets certain criteria, like it's overvalued, then we sell, all right? So we always buy and sell based on these rules. Let me ask you a question. Do you think that most people who invest, they buy and sell based on objective rules? Yes or no? Do you think most people buy and sell based on objective rules? Yes or no? No, right? Most people, number one, they have no rules. They don't even have an investing plan. Okay? And even if they have the plan, they don't follow the plan. Yeah? Most people, they buy and sell based on what? Based on what? Based on emotions. Like I said, when they get excited, they buy. When they get scared, they sell. Or they buy and sell based on the opinions of other people. They hear, hey, this guru is buying the stock, so I go to buy the stock, right? That guru said the market is going to crash, sell, I'm going to sell, right? Or they buy and sell based on news headlines. Okay? So if you do that, you will never get consistent profits in your investments. So never ever buy from FOMO. What does FOMO mean? FOMO means never buy from a fear of missing out. Okay? How many of you have bought something before because everyone bought it, you did not want to miss out, so you jumped in. And after you jumped in, it collapsed. How many of you have this experience? Okay? So never buy because of FOMO and never sell because of panic. Okay? So one reason why I've been so successful in investing, I've beat the market for so many years. It's not because I'm very smart. In fact, some of you may be smarter than me, all right? But it's because I'm extremely disciplined, okay? So for example, in the last 2 years, there were many stocks that went up. Like for example, Zoom, Roku, Teladoc, and all those Beyond Meat, right? And crypto. And everyone was saying, you got to buy these stocks because they're going to the moon, right? And for me, I refused to buy any of these stocks. And people said, but Adam, everyone's making money except you. I said, I don't care. So why didn't I buy all these stocks? Because they did not meet my rules. Many of these stocks I talked about, like you heard of ARK ETF? They hold a lot of these like what is it, Tesla or Roku or NIO, right? They did not meet my rules. Why? Because most of them were very overvalued. Most of them don't make money. I mean, not all of them, but some of them did not make any money, right? So I refused to buy, okay? And sure enough, what happened this year, they all collapsed, like 80%. Now, to be fair, the stocks that I have, which are great companies that make profits, they also went down. I'm not saying my stocks didn't go down, they also went down, but they didn't go down like 80%. Right? They went down like 20, 30%, right? And I know that the stocks I own next year or the year after are going to rebound 50, 100%. Whereas those stocks that people FOMO may never come back because those companies don't make money. Does this make sense, everyone? All right? So let me share with you a really great story that really inspired me. And it inspired me to be very disciplined and to only follow rules and not to be seduced by what other people are doing. So everyone can buy crypto and make money. I don't care. I'm not buying. Everyone can get excited and buy this stock like C or Beyond Meat. I'm not buying, right? And I'd like to share with you a story from history. And this story is about Warren Buffett. Okay, again, Buffett is one of the greatest investors in the world. He admitted himself that he's not the smartest guy. There are many people smarter than him, right? is not because he can see the future. No. But what makes Buffett so consistently successful for 50 years is that he's so disciplined. He only buys things that meet his rules. Okay, so I'm going to share this story with you. Now, how many of you are old enough to remember the dot-com bubble? This was back in 1998, 1999, 2000. Anyone here old enough to remember? Okay, great. Now, during the dot-com bubble, what happened? You see, Warren Buffett, again, he only buys companies that are making money. He only buys companies that are undervalued, right? Like Coca-Cola and McDonald's. He buys those companies. The trouble is, during the dot-com boom, companies that were making money, companies that were undervalued, they were all going down. McDonald's was going down. Coca-Cola was going down. American Express, all his companies were going down. And what was going up in the dot-com bubble? All the dot-com stocks that were not making money, stocks that were unprofitable, but they went up because of hype, because everyone said, oh, the dot-com is going to change the world. Does it sound familiar, right? So everyone was making money buying dot-com stocks except Warren Buffett. He refused to buy. He said, it doesn't make sense. They're overpriced. They don't make money. So he stuck to holding Coca-Cola, McDonald's, American Express, right? That kept going down, right? So let me ask you this question. How many of you have ever followed some investing rules and the stock didn't go up? It went down. How many of you have experienced that? You followed the rules, but your stock kept going down. How many of you have experienced that, right? And would you feel frustrated? You'd be like, what's wrong? I'm following the rules. It went down, right? And what's worse is that your friend, who's an idiot, who breaks all the rules, makes a lot of money. Who's experienced that before? It's not fair. My stupid friend's an idiot. He's making money. I'm losing money. I'm following the rules and he's breaking the rules, right? Never give in to the dark side, okay? So what happened was that is what happened to Warren Buffett, okay? All the idiots were making money except him. So during the dot-com bubble, Buffett's portfolio was down 23%. Whereas the S&P was up 18%, and a lot of idiots who bought the dot-com were up 100%. So Buffett was ridiculed for sticking to his investment rules. In fact, the magazine called Barron's, right? They ran an article criticizing Buffett. They said, what's wrong, Warren? They say he's a dinosaur. He's old. He doesn't understand the new technology. Does it sound familiar? It's like a lot of people criticize me. Oh, Adam, you don't buy crypto. You're a dinosaur. You're an idiot. You don't understand new technology, right? Same thing. History repeats all the time. Okay, so anyway, so Buffett refused to enter the hype. He stuck to his rules. And sure enough, what happened eventually? In 2000, the dot-com bubble burst. And all the tech stocks that went up collapsed 95%. And everyone died except Buffett. He's the only one who held on to the good companies that went up. And this is what happened. If you take a look at this chart over here, you can see what happened, right? So during the dot-com bubble, this is Warren Buffett's company, Berkshire Hathaway, right? So during the dot-com bubble, what happened? Can you see his portfolio kept going down, right? Whereas the market was going up. So imagine, how would you feel if the market kept going up, but your stocks went down? You feel bad, right? But you shouldn't feel bad. You shouldn't feel bad because you're following your rules. Eventually, you'll be proven right. So sure enough, when the dot-com exploded, the S&P collapsed. And then Buffett, who held great companies, hallelujah. And in the long run, he beat the S&P 500 consistently. Does this make sense, everyone? Are you listening? Do you understand this lesson that I'm trying to tell you? Okay. Yeah. So at the end of the day, remember this, guys. At the end of the day, what matters most in investing is cash flow. Companies that generate cash flow will always go up eventually. They may go down temporarily because of whatever reason, right? But over time, they'll always go up. Okay. In the short run, companies that don't make money, that are crap, can still go up. In the short term, crab can fly. It's called hype. So never have the FOMO to jump into crab. Stick to your guns, follow your strategy, and eventually you're going to be the one making all the money. Okay? Very good. Fantastic. All right, so that's psychology rule number 1. Okay. Psychology rule number 2 is only invest in what you understand. Okay? Here's what I found. Stupid Siri. Okay. Only invest in what you understand and what you have thoroughly researched. Okay. That's why in my investing course, I tell people, or I teach people the investment process, that before I buy a stock, it must pass my 7-step process. So before you buy a stock, you have to ensure it passes the 7 steps. Okay. So never blindly rely on recommendations or tips from so-called experts. Okay, so let me give you an example. Let's imagine that tonight I'm going to have dinner with some great investors. I'm going to have dinner with Warren Buffett and George Soros and Jim Rogers and all the gurus, right? And during dinner, they're all talking, and it so happened that they're all investing in the same stock. They are all buying, let's say, Micron, okay? All my role models are buying Micron. Now, question, would I buy Micron? Yes or no? If all my gurus are buying Micron, will I buy Micron? Yes or no? No, I won't. No. Because I will not blindly follow what other people are doing. I don't care who they are, right? But what will I do? I'll take that idea, Micron, and I will do my own research. I'll put it through my 7 steps, right? So if it passes my 7 steps, then I'll buy. If it doesn't pass, I don't buy. Does this make sense? So although I really admire Warren Buffett, I follow all his strategies, but there are many things that he has bought over the years that I refuse to buy. Like he bought General Motors. He bought a lot of oil companies. He bought a lot of airlines. I refuse to buy because it doesn't fit my investment strategy. Does it make sense? So you could always follow your investment plan. Yeah? And again, you have to stay within your circle of competence, right? Now, you guys know by now that I have never bought Tesla, and I never intend to buy Tesla because to me, honestly speaking, I've done all my research on Tesla. I really don't understand the business. I just don't understand it. It doesn't meet my criteria, right? Same thing. I'll never buy cryptocurrencies because I just don't understand it. No matter how much I read about it, I don't understand it, right? And so I don't buy Tesla, I don't buy crypto and all that stuff. But if Tesla and crypto goes up 500%, for example, let's say from today it goes up 500%, right? Does it bother me? Does it bother me? It doesn't bother me. Why? Because I will make a lot of money as well investing in other things that I feel comfortable with, that meet my investment criteria. Does this make sense? So what I'm saying is that in life, you don't have to win at every game. You just have to win at the game that you're comfortable at playing. You don't have to win at every stock. You just have to win at the stocks that you understand. Do you follow everyone? Okay, so that's what I mean by invest in what you understand. Okay. Now, how many of you here have received analyst reports from brokers, right? You've got brokers that send you recommendations to buy this and sell that. Any of you have received that? Okay. So I used to receive a lot of recommendations from my private banker, my broker. Hey, Adam, buy this stock, buy that stock, right? And when I read all these reports, I read it for the facts, right? The facts are useful. The research is useful, but never blindly follow their recommendation because they could be wrong, okay? I'll give you a very, very good example. Many years ago, my broker, won't mention the name of the broker, I blocked out the name, right? Okay. They send me this report and they say, hey, recommend buy this stock called Nobel Group. Now, Nobel Group was the largest commodity company in Singapore. It was one of the biggest companies in Singapore, in fact, right? And they said the price is now at $1.56. And they had a 20-page report on why it's a great company. They said target price is going to go to 205. All right. So what did I do? Did I say, okay, they recommend the stock, I'll buy? Obviously not. What did I do? I put the stock into my 7-step checklist, right? And guess what? It failed most of the steps. So let me give you an example of what steps it failed, right? So Nobel Group, number one, they have got negative cash flow from operations. That means they are bleeding cash. Although they showed an accounting profit, but they got negative cash flow. That breaks my rules. Okay, number one. Number two, Nobel Group had profit margin less than 0.5%. That's too low. Usually when I invest in a business, I want the profit margin to be at least 15, 20, 30%. But it's 0.5% profit margin. Okay. What else? Their debt to profit ratio was over 12. That means they need 12 years of profit to pay back their debt. The debt is too high. My rule, right, is the debt to EBITDA ratio must be less than 3. Next, debt servicing ratio should be less than 30%. But their debt servicing ratio was more than 50%. So once I analyze the business and I say, hey, it fails many of my steps, I said, I'm not going to buy it. But it was a very popular stock. Everyone was buying it. So my students say, hey, Adam, everyone's buying the stock. It's recommended. Should I buy it? I say, well, I'm not buying. All right. So sure enough, what happened? On the 8th of November, this stock was recommended. And shortly after the recommendation, in fact, the next day, the price dropped from $1.56 to $1.08. 31% drop, right? Now, let's imagine you bought the stock at $1.56 and it dropped to $1.08. And you realize, shit, I made a mistake. It failed. The criteria is not a good business. What's the right thing to do? What should you do if you realize, hey, it's not a good business. I made a mistake. Sell, get out straight away. Sell, take whatever's left, reinvest it in a great business that can grow, right? But do you think most people will sell? No. Most people say, but if I sell, I lose money. I can't lose money. I hope you'll go back. I hope. Hope is for the hopeless, right? In investing, hope is for the hopeless. Once you realize it's a mistake, get the F out, okay? But most people didn't get out and they held and held and held. One day it'll come back, one day it'll come back, one day it'll come back. It dropped all the way to 45 cents. Then dropped to 10 cents, dropped to 5 cents. Eventually it went bust, went to zero. And sadly, a lot of retail investors lost everything. Like FTX, like High Flux, like Lehman Brothers. These are all the same examples, right? And then what happened? And then on the media, a lot of investors said, I was cheated. I was cheated, right? Now, I feel sorry for them. I feel sorry they lost their money, right? But the point is this, in investing and in life, if you keep blaming other people, oh, it's the broker's fault, he recommended this to me, or it's a stupid Jerome Powell's fault, he raised interest rates, the market crashed. You know, you blame the Fed, you blame the broker, you blame your luck, you blame God, right? You blame the whole world. What happens? You don't learn anything. If you blame other people and you give excuses, you go in circles, you don't learn anything, and you keep making the same mistake your entire life. You will never succeed. Does this make sense? So although I feel sorry for them, but the fact is that the reason they lost money, don't blame the broker. It's because they did not do their research. Now, lesson number 3, very important, okay? So far, is it useful, guys? Is this webinar useful for you? Okay, great. Now, how many of you have ever bought a stock before? After you bought it, it dropped the next week, the next month, and you felt bad. You felt like an idiot and you lost confidence. Something's wrong with me. What's wrong, right? Okay. How many of you have bought a stock? After you bought it, it went up next day, next week. You felt like a genius. I'm good. Right? Now, I'm here to tell you this. That is the wrong psychology when it comes to investing. Because in the short term, listen carefully, in the short term, you have no control over where the market price is going. You have no control. A great business, the price can still drop 10, 20% in the short term because of manipulation, because of news, because of emotions. A lousy company, the price can go up because of hype. So in the short term, where the price goes has nothing to do with the business. Where the price goes in the short term, you have no control, and it's often random. Okay? So most investors judge the success of their investments by the short-term price movement, right? Again, they buy the stock, the price goes up, they feel smart. The price goes down, they feel stupid. But that is not the right way to look at it. Remember, in the short term, stock prices are driven by emotions and manipulation and not by the underlying business fundamentals. In the short term, the stock price can be vastly different from the business fundamentals. So instead of judging your investment performance by the short-term price movement, judge your investment performance by how the underlying business is doing. Does this make sense? So if you, remember, when you buy shares of a stock, you're buying a piece of a business. You're becoming the part owner of a business, right? So focus on the business, not the short-term price movement. So as long as the business you bought continues to be making money, their sales are growing, their cash flow is growing, it's a good investment. You've done your job. Does this make sense? Because as long as the business keeps making more and more money, guess what? The share price eventually will be much, much higher. Okay? So don't be happy if the price goes up tomorrow. Don't be sad if it goes down because you have no control over it. As Benjamin Graham said, in the short run, the market is a voting machine. In the short run, the market is like a fashion show, right? Sometimes this is in fashion, that's in fashion, and there's no way to know what goes in and out of fashion in the short term. But in the long run, the stock market is a weighing machine, which means over time, companies that make the most money will be worth the most. All right. So as long as you, again, focus on buying and holding companies that make money, you will do very well. I guarantee you that. Okay. I guarantee you that. So I like to think of the market like a person. We call him Mr. Market, right? And Mr. Market is a manic, depressive, alcoholic drunk. And Mr. Market has terrible mood swings. On certain days, he's very happy, very excited. Prices go up like crazy. Certain days, Mr. Market is depressed, he's an alcoholic, and prices go down, right? The important thing is this. Let Mr. Market serve you. So if he offers you a crazy low price because he's depressed, take advantage of Mr. Market. Buy shares from him at a crazy low price. If Mr. Market quotes a crazy high price, sell it to him at a crazy high price. So take advantage of Mr. Market, let him serve you, but do not let him influence you. All right? Do not let him influence you. Do not let him instruct you. So what that means is that when Mr. Market is depressed and the market's down, don't get depressed. Because if you get depressed yourself, you're as crazy as he is. Does this make sense, everyone? Okay? So remember, if you buy shares of a good business, and in the short term, the market drops because of panic, you have two choices. Number one, the first choice is take advantage of Mr. Market and buy more shares at a bigger discount. Or number two, if you have no more cash to buy shares, ignore Mr. Market. Just ignore him. Because eventually, he'll be happy again. Okay? If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.